When you're thinking about the big picture in auditing, what you're really thinking about is who is responsible for what. Auditing is about responsibility. It's the responsibility of one party to do one thing, the responsibility of another party to do something else. So the big first step is understanding what everyone's role is. First, what is the auditor's responsibility? On the most fundamental level, the auditor is responsible for an opinion on the financial statements. The auditor will have greater responsibility to that when we get into detail, but their first responsibility is to issue an opinion. So what are those other responsibilities? The auditor is responsible for being competent. That means that they have appropriate education, continuing professional education, experience. All these factors are to ensure that they have the judgment, the competency to make the right judgment, so they can know what the right answer is. Beyond that, the auditor is required to maintain a mindset of professional skepticism. Sometimes this will also be called independence in fact and in appearance. The auditor needs to be independent in fact because they need to make unbiased judgments. They need to be able to um, assess what is real and true. But they also need to be maintained independence in appearance because the public needs to believe that their judgment is unbiased. And so even if you are unbiased, if people don't believe it, it's not enough. The last thing, the auditor is responsible for acting with due care or due diligence. So they have to put in the effort. They cannot take shortcuts. Well, the auditor should always strive to be efficient. They should never do so at the price of effectiveness. And so those issues will come up time and time again. What is the auditor responsible for? Their opinion, acting with sound judgment or competence, acting with a professional skepticism, and showing due care. But there is also another possibility for a CPA, the non-auditor. That is when the auditor is providing some additional services that are not audit related. Typically speaking, we would say the auditor cannot provide both services simultaneously, but there are some exceptions to that. For example, tax services are generally not viewed as violating auditor independence. But the auditor can, for example, compile the financial statements. That's where you take all the underlying information and create the financial statements. So you're going to see that come up from time and time again when we think about the auditor's role. Well, what are the roles they cannot have? And so you'll want to review that closely. Next thing is the responsibility of management. Broadly speaking, we view management as responsible for everything related to the financial statements except for the auditor's opinion. That means the numbers, the notes, the internal controls, the presentation, the classification, every element, not only ensuring what is there is accurate, but what anything that should be there is there. So those notions of completeness and existence come in. The manager is also responsible for providing the auditor all the evidence they need to complete the audit. The manager is also responsible for truthfully answering the auditor's questions. If they mislead the auditor has legal recourse against management for deception. So the management's role is everything. And so as a default thought, I usually assume management is responsible. But there are other people involved in the audit too. The board of directors or the owner, if it's a private company, that is like a sole proprietorship or a partnership. The board is responsible for selecting the auditor and approving non-audit services if appropriate. They'll also be responsible for setting the auditor fees. They're also responsible for receiving the auditor's report. When the audit report is actually written, it will be written to the board. They are the ones that employ the auditors. The auditor does not work for management. It's part of that independence requirements. Now, you'll sometimes think about the board and think, okay, if it's a company's got a board of directors, it must be a publicly traded company. But there are private corporations too that would have a board, but they would rely upon the private company standards. So the AICPA are the regulators that develop the US private company standards. They have European counterparts, they have global counterparts, but in the US, the clarified auditing standards were drafted by the AICPA. They're responsible for that. They set the policies that govern auditing as a whole. These standards we've been reviewing during the training week, and we'll continue to talk about them throughout the semester. Their public company counterpart is called the Public Company Accounting Oversight Board. And on some level, we're starting to get into a bit of vegetable soup here, or alphabet soup here, with all the different letters, but it's important to not lose track of what they mean. These are regulators. They work with the Securities and Exchange Commission, or the SEC, to provide governance of the auditing profession. They audit the auditors. They have no authority over the clients. They assess whether the auditors are doing appropriate work. And so you want to be careful when you're thinking about them. They don't determine that whether there's audit misfindings. They find that the auditors process. And so we'll think a lot more about them as we go throughout the semester. The state boards, there are 50 of them approximately, and they govern the auditing profession, or CPAs, in the state. And so they're the ones who you get your license from. Each state has slightly different variations from the number of hours you need. Some need 120 hours, some need 150 university hours. Some require ethics classes, some don't. If you get into trouble, it'll be the state board that issues disciplinary action. State boards do not set the auditing standards. They are about administering at the state level licensing. And so you will actually get your, you'll be a CPA licensed in the state of Texas. There's a lot of reciprocation that goes along with that. Sometimes you go to a different state, you need to do additional coursework. Colorado, for example, requires you to take 2 audit classes. So even if you're thinking you're going to be taxed, if you're going to live in Denver, you're going to need to take that second audit class. Financial Accounting Standards Board does not directly relate to auditing, other than they set the rules that govern the accounting profession. And the auditor's job is to assess whether the client is in compliance with the Financial Accounting Standard Board's rules, which means the auditor must be aware of what the rules are to be effective. We heard that a lot during our training week from guest speakers talking about the lease standards. It's a huge audit area, and the responsibility of the client is to make sure they've not only done the right thing, but they've documented it. What we're also going to see is the responsibility to use words properly. And so I mentioned this, is we're going to see 3 words in particular come up a lot in this unit. Should, must, and may. Should means the auditor should do this. They are not required to do it, but there's an expectation they're going to do it unless there's a reason why they can't. So for example, the auditor should talk to the CFO. However, if the CEO left the company, the CFO passed away, the auditor cannot interview them. That does not mean the auditor cannot proceed. The auditor will just have to find alternative evidence. The auditor must maintain their independence, meaning there's no scenario where the auditor can proceed if the auditor's violation of it violates independence. So this is a non-starter. So there's certain things the auditor must do. They must have professional skepticism. They must have appropriate competency. They should do certain procedures, but there may be alternatives. The last one is may, means it's a permissible act, but there's not an expectation you can do it. So the auditor may provide tax services, meaning it's allowed, but it's not required. And so we want to keep these all in mind. So as we think about the big picture of auditing, we want to keep in mind these various responsibilities. And that's what this unit's going to pick up in testing as you move forward. Who's responsible for what, and are they honoring those responsibilities? So you'll see a lot of test questions on, is this action allowed? Is this person who's responsible for this? How do you juggle these responsibilities? And so dig in, have fun, talk to you later.